it is a negative that we have debt servicing bills today that exceed the defense budget. So we are paying today more from the federal budget to just service the debt, the interest that we pay on the debt, right? And it's at 20% of the budget. That's a huge number, right? But then there's a little bit of help coming on that issue because as the interest rates have come down, like I said, 7 rate cuts in the last 2 years.
I am super excited about this show. As you know, this is the Mark Haney Show on a mission to ignite the entrepreneurial revolution right here in the hometown we love. And we do that by building the Backyard Advantage, which is the most connected community in the world for local entrepreneurs. But occasionally, we get to share something unique rather than just an entrepreneurial story. But we are going to share an entrepreneurial story of sorts, plus get a macro view of what's going on in our economy, not just in Sacramento, not just in the state of California or the U.S., but globally as well, from a well-known economist in Sacramento. And this guy came here with 2 suitcases and $20 in his pocket. He was on the show about a year ago, and Sanjay Varshney, he is founder and principal of Golden Stone Wealth Management, but he's the chief economist and publisher for the Sacramento Business Review. He's also the professor of finance at Sac State University. But beyond the title, he's a guy that comes here with general optimism about why to build in the United States. And I share that same thing, but I come from a completely different beginning, but I share it. Maybe it's the way I was raised, but welcome to the show.
Thank you so much, Mark. Glad to be back.
Yeah, I am glad to be here. Now, you still can bring that generally optimistic, viewpoint on what's going on, or?
Absolutely. Mostly good news, maybe some not so good news.
Yeah. Well, last year, a lot of the things that you spoke about were actually, they came true. I think a lot of it happened. It was a fast and furious sort of moves in last year after we got the new administration, and that did affect things in the economy. So maybe I'll just kind of make this a 2-part question. How are you seeing the macro economy today, and how has some of the events and the moves that happened last year affecting, where we're going?
I would say 2026 is shaping up to be a much better year in many ways. Last year, when the new administration took over, there was uncertainty. There were questions about, policies, tariffs, especially because when in April, the Trump administration announced tariffs, you could see the market sold off quite a bit. Mm-hmm. But I came, I think, for the interview well before that. Yeah. And my thinking was that there was a lot of very powerful, positive drivers in place already. I was predicting 3 rate cuts. We got those. I was not too worried about inflation. And you could see that inflation has fallen dramatically to 2.7%, the most recent reading that we saw. A lot of people were very worried about Trump and what he would do, for example, with tariffs and everything else. And again, my view was that in the big scheme of things, when you look at the United States, the largest and the most powerful economy on the planet, where one company like NVIDIA has a market cap that's larger than the entire British stock market or the German stock market. We got to put those things into perspective. So yes, will there be some disruptions? Absolutely. Are the disruptions going to be massive enough to really basically sink the economy? The answer is no. So last year, if you recall, I think once we were past the tariff conversation, we found a couple of very pleasant things happening. One, tariffs were not as inflationary as people thought, and they were not as destructive as people thought. And at the end, we did get some trade deals with some other countries, right?
So let's talk. Yeah. I'm going to stop and talk about tariffs for a second, because there's other things that I know that you want to touch on in terms of what happened last year. But tariffs specifically scared everybody and caused a big uproar. And in one of my businesses, I have one business that does some importing, and we were affected dramatically by tariffs for about 3 About 1.5 quarters, 3 or 4 months. It got people hesitant. We had to try to pass along the tariffs, but all of that demand has stayed there. Now things are looking good. Everybody's sort of come to grips with what it all means, and those purchases are rolling in. It's a video security company that focuses on enterprise type security, and a lot of those things they're behind us now. We had a great fourth quarter, so it's an interesting thing as to how it scared everybody, but in reality it just reset things here and there and put us in a position to build a better trade policy for the U.S. overall, and getting what I'm hearing is trillions of dollars over the next several years are going to be invested in the U.S., and a lot of that's based upon having tariffs as a negotiating tool.
Absolutely. Short-term pain for long-term gain, as I call it, right? And I think to a large extent, it was hard to argue that the status quo was okay. Because if I just go back and take a look at, for example, the year 2000, at that time, I would say most countries in the world viewed the United States as their largest trading partner. Fast forward to 2020, and suddenly the entire map changed, where most countries were viewing China as their largest trading partner. Some of it is okay because we understand that this is basically a world that has increasingly become more complex, and so every country has a competitive advantage in certain things. But I don't think the status quo was sustainable long term, and so that's why I think in the short term, yes, there was disruption, there was a lot of noise, people were unhappy, some businesses got hurt, absolutely. But then the idea was, can we use that as a negotiating tool, like you said, to lay the foundation for something stronger? And that's why when you ask me about 2026, I feel better about 26, given that now we have several drivers in place which are very positive, and I can talk about those. And then, of course, we still have some challenges that we have to deal with as we go forward. So if you want to talk about the positive drivers, right, the economy actually has been much more resilient and stronger than most people gave it credit for.
Yeah, we had our GDP in the fourth quarter last year was in the 5s.
Yes.
Yeah.
And those numbers haven't come in yet, but the expectation is going to be close to 5. The third quarter GDP was 4.4%. Second quarter was 3.8%. So you can see that these numbers are not basically, sort of ordinary numbers.
Right. Those are well beyond expectation.
Numbers. Yeah. These are great numbers. And that momentum is carrying into 2026. So the Atlanta Fed is once again expecting the second quarter GDP this year to be fairly positive and be upbeat. Like I said, it's a K-shaped economy. So that's maybe some of the bad news. The top 1/3 of the households by income account for almost 70% of the total spending that we have in the economy. So when people say, oh my God, we hear about a lot of folks who are struggling, living paycheck to paycheck. They are worried about inflation. They're worried about what they're paying at the pump, what they're paying for groceries in the grocery store. That's for real. Because in many cases, prices today are 25 to 50% higher in absolute terms from the pre-COVID levels.
But right, from the pre-COVID levels before we printed a lot of money.
Exactly.
Yeah.
We pumped more than $10 trillion into the economy at the time in the name of COVID. So those folks are struggling for real, but the economy is humming for 2 reasons. One, the folks who are rich got richer through the stock market in the last 3 years. The stock market has done extremely well, and that wealth effect obviously is playing out in the consumption in the economy, right? So the rich people are spending a lot of money, and that's what counts because, like I said, the top 1/3 account for almost 70% of this total spending, right? And then, of course, we saw this new AI trade with CapEx that basically got unleashed in the last couple of years. And last year was where we saw a massive amount of infrastructure-based spending on data centers, spending on all kinds of stuff that supports the AI trade. And that is going to basically increase in 2026. So that also provides a boost to the economy, right? And then our imports came into slightly better alignment with the exports. So remember, we had massive trade deficits. Those shrunk a little bit, and that's helpful because the way the GDP is calculated, if our imports are going down a little bit and our exports are increasing a little bit, that actually helps the GDP.
Yeah. So the tariffs have actually, we talked a little bit about COVID for a second. We discovered during COVID that we were over-reliant on supply chain for a lot of critical things that we need to operate our economy. It could be masks or something like that, just to, basic things. And so I think the desire or the design to get some of that critical manufacturing back to the U.S. over time, that's not only going to be good for jobs. I think that's going to be good for national security.
Absolutely. And in a way, they will also help replace some of the jobs that we know are going to get lost because of the AI disruption. Because white-collar jobs, you can see entry-level jobs especially, are under pressure, both in the tech industry, in the financial industry, many other industries. So to have manufacturing come back or some of the supply chains come back is very refreshing. Imagine we are still at the point where 95% of ibuprofen that we consume here in this country comes from China.
Wow.
And that is a very vulnerable position to be in.
Yeah, that gives me a headache just to hear that.
You need the ibuprofen, but this time not from the China,
Yeah, that's right.
hopefully from the U.S.
Yeah. Interesting that, okay, so the tariffs have got their own effect. It's interesting. There's so many moving pieces, but the tariffs have an interesting set of effects that, and we haven't got into all of them, but then if you add in the big, beautiful bill, as they call it, right? This new bill that incentivizes through the tax policy to invest into factories and infrastructure where you have expensing that instead of amortizing the depreciation over several years, there's all kinds of reason to build the factories now versus someday.
And we're already seeing that. We're seeing chip manufacturing, for example, come back to the U.S. Some of the other, major processes that were basically offshored for the longest time are now coming back to the U.S. The big, beautiful bill is heavily front-loaded with all the benefits. And the expectation is that we are probably going to see at least $100 billion plus in boost from that bill in terms of tax savings and in terms of the infrastructure spending that is going to go on as a result. So that's another driver of the optimism for 2026. And then don't forget, besides the one beautiful bill, the boost we're going to get from that one, we also had 7 rate cuts in the last 2 years, which are phenomenal. So remember, go back to 2022 and the markets crashed primarily because inflation was hitting 9.2% and the Federal Reserve was forced to raise the rates really fast. It was fast and furious. You could see the rates went up very high, very soon. And of course, that pace was going to be disruptive. Fast forward now to 2026, 7 rate cuts in the last 2 years, plus I'm predicting 2 more rate cuts this year. To normalize the rates as well as normalize the economy, because for 25 years we were abnormal. We had a zero interest rate policy, and literally we were just putting free money on the table. Then came the inflation at 9.2%, which basically took us in the other direction where the rates went up too high. We were used to 2.5% 30-year fixed rate mortgage. Suddenly you're paying 7% plus, right? That is not sustainable either. So I'm really glad to see that inflation has come down, number one. Number two, the Federal Reserve has been responsive. So we have seen those 7 rate cuts, but we're still not there yet. Yeah. The 3.5% federal funds rate where we are right now makes the real rate still too high. We need the consumer rates to come down further from here. The auto loan rates need to come down a little bit more. The housing market needs to stabilize more. And we need the mortgage rate to come down a little bit. I'm not saying it's going to come down a lot because the mortgage rates always follows a 10-year treasury and it's going to stay sticky. But if we can get the rates to normalize, that will normalize the economy for the first time in the last 25 years. And that's a great thing for America because we have been anything but normal these last 25 years.
Okay, I'm going to circle back to the rates in a second, but in terms of 2026 and maybe 27 and 28, because we're at the beginning stages of this investment into factories and the AI data centers and all the things that go with that. We're at the beginning. I think we're in the first innings of that money. The numbers I'm hearing are trillions, and we're talking about hundreds of billions now. So as the bigger investments start showing up, that's going to provide, I guess, jobs associated with construction, and that'll have a positive effect on the economy. But then as the data centers get built out and we end up with more AI, more productivity, that's going to continue to grow. I mean, don't you think? That's my sense, is that the growth tailwinds are at the beginning stages right now.
That is exactly what's happening, and that's the reason why the optimism level is higher than what you might sense from general conversations in the media, or what you're seeing on television, or some of the pessimistic economists are putting on the table.
Yeah.
The productivity growth is sensational right now, and the concern that wage inflation was going to basically be very detrimental to businesses is being offset quite a bit by productivity growth, right? And that's going to continue. And I think because technology is helping people become more productive, technology in general is also very deflationary. So it keeps prices, under control to a large extent. And then we have to remember that we have huge pressures with our aging workforce. So we have an aging population in the United States. We have an aging population in Europe. We have an aging population in Japan. We have an aging population in China. So imagine the entire Earth, planet, is right now facing a massive aging process and pressures that come along with it. Household formation is not as active. Families that have children under 18 are shrinking in numbers. And all that is going to show up in the economy somewhere, right? So there are good things happening. There are some not so good things happening. But like I said, the drivers are very strong, primarily coming in from good economic, spending, the boost from productivity growth, all the manufacturing and all the construction that you just mentioned that's going to go on from here on. Yeah.
And what about limiting the immigration, right? We've closed the border, and now it's much more limited immigration, which does affect the workforce. Is that starting to show up yet in the cost of labor? Are there shortages anywhere in terms of, skilled workers?
Yeah. It's a great question. So United States has depended very heavily on migrant labor for certain industries. Think about California here, for example. The farm labor here depends very heavily on that immigration that takes place, right? And it's hard to find those kind of workers otherwise. Will those industries be impacted? The answer is absolutely yes. Will there be some benefit to wage increases because of the limitations on the immigrant labor coming in? The answer is yes. So there'll be some positives. There'll be some negatives. I think we want to make sure we separate immigration that brings in very highly skilled labor from that is not highly skilled, which may be illegal at times, and is basically maybe draining resources from the economy too, right? Skilled labor, in my opinion, still is dying to come to the U.S.
Okay.
So regardless of the negative...
And when you say skilled labor, are we talking about engineers?
Yes.
Yes, okay.
Yeah. Last year, with all the noise that we saw, especially regarding tariffs, there was this false narrative that was put on the table that the world was, hating the U.S. and people were moving away from the U.S. dollar and people were moving away from U.S. assets, and money was basically drying up in the stock market because foreign investors did not want to basically invest money in our markets anymore. All that stuff lasted for less than a month. So if I go back and take a look at data now, we found that investors poured even more money into U.S. assets and into the U.S. stock market last year. And yes, the dollar might be weak right now, but certainly there's absolutely no risk of the dollar going away or the dollar getting replaced by some other currency in my lifetime. I've talked about this, at other forums. The U.S. dollar is still the major denomination that the world basically has confidence in. Because the other currencies, the world does not have the confidence. When people say, oh my God, Japan and China will walk away from US treasuries, I said, I don't think they can afford to walk away because they would hurt themselves. Where else will they take the money? Because we are still the largest, like I said, stock market and the bond market for the world. We are the most institutionalized. We are the best regulated. We are the most transparent. There's a reason why the world has a lot of confidence in the US. And then don't forget about size and perspective. So when people say, oh my God, the world is going to stop investing in the US, I'm saying, look at the sheer size of a market. We are still 60% of the world's stock market in the US. That's how big our markets are here, right? And like I just gave you the stats, where one company is larger than most economies of Europe, which is the next
that's amazing
major focus for people, and say, oh, let's invest in Europe. So there's a lot of positives we have here, but I think they often basically get disregarded or they get overshadowed by negative conversations. And I know we have started the year again with the same conversation again, whether or not the U.S. has lost respect in the world, and our foreign investors not going to come anymore. I'm saying no, they're going to come here.
Okay, let's maybe talk a little bit about the view of the U.S. in terms of our debt, right? So we're approaching $40 billion in debt as a country. Or trillion. Yeah, we go Mr. Comma there. 40 trillion. And, we're not there yet. I think we're at 38.5, something like that. But it's escalating. Our deficits look like they continue to escalate. But our growth is also speeding up, which keeps our bonds, we talked about the 10-year. Yeah. It is, I think it's around 4.2 right now.
Yep.
And so and that's where, interest rates for our 30-year mortgages tied to. So it makes you kind of want to make sure that doesn't go up too much or go down a little bit. Seems like it would be good. Is there anything that we can do that we're not doing now to get that to go down a little bit? It doesn't seem like the administration has a lot of effect on that, other than trying to grow and balance the budget, get closer to a balanced budget. Yeah. Is there anything else that we can do? I mean, we can't just try to go buy the long bonds to try to drive the price down, can we? I guess we can a little bit, but is it going to work?
Yeah. Well, being the largest economy in the world and being the most a robust economy in the world still, we have a few things that may not sound good, but we can get away with. Like, for example, printing more paper, right? And the United States increasingly has been doing that, right? It is a negative that we have debt servicing bills today that exceed the defense budget. So we are paying today more from the federal budget to just service the debt, the interest that we pay on the debt, right? And it's at 20% of the budget. That's a huge number, right? But then there's a little bit of help coming on that issue, because as the interest rates have come down, like I said, 7 rate cuts in the last 2 years, if we don't basically keep chasing long-term debt, issuing more of that, right? And keep financing at least the debt that's falling off the books with short-term debt,
okay,
which has become cheaper, right? At least in theory, our bills would be slightly better controlled.
Okay, that makes
right?
sense.
At least in the near term, right? So in the short term, if we can bring our debt servicing costs down a little bit, especially with lower rates, I think that's a positive. The challenge that we have, like you said, is that regardless of whether you're Republican or Democrat, they're both used to spending a lot more than they should. And that deficit financing is now becoming a burden on the next few generations, because when you talk about $40 trillion of debt, that question comes up again and again. How do you solve that problem, right? How do you basically bring that number down? And can we bring that number down effectively in my lifetime, right? That's hard. That's going to be very hard.
Yeah, what's crossed my mind is obviously there's one theory that grow your way out of it at some level. Enough productivity, enough GDP growth, enough pay enough taxes because of our strong economy that we can chip away at that problem, or at least change the percentages of that problem so that people still have full confidence in us paying our bills as a country. And then that's. To me, that's one thing, but inflating our way out of it is the other thing that kind of goes through my mind. Is maybe we'll just allow inflation to sort of happen and let some of these longer bonds just roll off.
Yeah. So I think a couple of good things are happening even on that front. So I know a lot of people are worried that President Trump is running the economy extra hot, right? And that's going to basically increase inflation, possibly, because when you're growing the economy at 5%, 4%. That's happening because of all that extra spending that's happening with AI and the data centers and the infrastructure spending, and some of that is basically deficit spending by the government, right? The fiscal policy. But on the flip side, we also recognize, like in fact, I've told you before too, I'm in the camp that believes very strongly that we are deflationary in general. So by running the economy extra hot, will we necessarily take inflation up to 8% or 9% again, right? And my theory is no, because we're deflationary in general, and we'll probably stay at that 3.5% range. And 3% is not a bad place to be for inflation, because during the last 25 years, we went through several periods where growth was extremely anemic in the economy. And it was also because of the fact that inflation was well under 2%. There was no producer pricing power. So if you're a business owner and you're producing something, like let's say cars or whatever you're producing, and you're selling those, don't you want some pricing power, right? And we used to complain constantly during the Obama years that we were anemic on both sides. We were anemic on the economic growth, and we had no producer pricing power because inflation was below 2%. So we don't want to be deflationary in that sense. We want to have inflation somewhere, like I said, in the 2 to 3% range, which is very healthy.
Well, one thing that crosses my mind is that if things can be disruptive, and so one item might go up in price, another item may go down in price, and it all sort of washes out. But that's not necessarily inflation. When I think of inflation, I think of more money chasing more few goods, like printing money or the money supply increasing in some way. So here's my question: does a strong economy necessarily boost the money supply?
It may or may not.
Okay.
So that's a very good question. The reason why inflation has come down a lot is because money supply has come down a lot, right? And money supply went through the roof post-COVID, primarily, again, because the government created artificial money and pumped it into the system. 10 trillion plus was a lot of money. In a more normalized economy, money supply is the most critical driver of inflation. And I would say right now, money supply is actually going in the negative direction. We have seen a fairly good drop in money supply.
We started a little bit of a printing, I think about 3 or 4 weeks ago, just to kind of help with loosen the cogs in the machine to keep things running. But it seems like, is that immaterial?
Immaterial.
Okay.
In the big scheme of things, I would say these are very small moves. These are very small decisions.
Yeah, they're not calling it quantitative easing, but they are, buying, printing a little bit of money.
Right. What would be helpful is if the Fed basically rolled off some of their balance sheet, because the Fed right now has a lot of debt on their books. So like I said, everything I see right now is very encouraging because it's helping normalize stuff. Things that we were used to more than 25 years ago. The last century, if I look at how the U.S. economy has evolved and how the markets have evolved. So there's some great things happening, I would say, that allow me to be very optimistic, like I said, going forward about 26 and 27 and 28. And, we can argue this is probably still the third or the fourth year of the bull cycle. Bull cycles typically last 7-8 years at least. So yeah, a lot of good things happening there.
Interesting. All right, can we talk about a couple asset classes?
Yeah.
a lot of people talk about gold and precious metals and rare earths commodities. They seem to have tailwinds right now because of all the build out of the data centers and so on. That's not affecting gold, I suppose,
Silver,
but it's affecting silver potentially and copper and things like that. So commodities generally seem like they're at the beginning of a growth cycle.
Yeah. And again, to put the commodity cycle into perspective, their bear cycles last about 20 years. Bull cycles last about 12. We were in a very strong bear cycle in commodities for the longest time. So if you go back a few years, we could see commodities going nowhere. So now, finally, we are seeing life in commodities, right? And that cycle is probably going to play out for the next few years. Having said that, within the commodities asset class, there are a couple of things that are happening which are unusual. So gold went up, and this is the third time in history that gold has gone up as much as it did. Because, I mean, just going back into history a little bit, if you had bought gold at the peak in 1980, it almost took you 42 years to recover your money on an inflation-adjusted basis, because gold went sideways to down during that period, right?
And we had a little bit of inflation, so
So now finally gold has picked up again, but gold has picked up not because, there's something unique going on in the commodities market. It's primarily because there are segments of the world that are piling up on gold.
China's buying up a bunch of gold.
5 times. China gold buying last year in 2025 was 5x, where X is your normal for China. India's gold buying went up 4x.
Oh.
And then when they watched the gold prices going up worldwide, guess what investors did? They piled into gold's ETFs and other forms of gold assets that might be available for them to invest in, right? So there was like this huge mania going on. And if you ask the question, why was China buying 5x? 2 things happening there. The consumers have lost hope and confidence in
China because they're printing money. Yeah.
Chinese government basically has done a very poor job with the property markets. You can see the property markets have crashed and they're burning because they were all debt driven. And there's a lot of debt that has come undone in the last 2 or 3 years in China. So imagine with all the property markets and prices crashing, the Chinese people who were used to buying real estate as a second home, because that was their way of becoming richer. In the US, we believe in going into the stock market. In China, the Chinese were not investing in the stock market because the stock market was very narrow, state-owned companies mostly. So everybody was wary of the fact that the government is artificially controlling the stock market. So the Chinese consumer typically bought real estate as a store of value. When that crashed and the Chinese became even more disillusioned with their own government, they started buying gold. So last year, the consumers have been hoarding gold. Then, of course, with the tariffs and the trade spats we have going on, the Chinese government started doing the same thing because they said, hey, how do we move away from a reliance on the US dollar?
Yeah, little insurance policy.
Exactly, little insurance policy, exactly. And so central governments across the world did that last year. India did the same thing. So this trade spat or trade tariffs or whatever you want to call it, right, has ignited some asset classes to go haywire. So gold is one of them. And then, of course, silver was a different story because, like you yourself said, silver is something that's used in all this AI infrastructure, in these data centers. SpaceX, for example, uses a lot. EV cars, use silver quite a bit. So silver just got a huge demand.
So it's interesting. Okay, so maybe, we're really talking about 2 different things. I kind of threw them in the same bucket. Yeah. Gold is the buying of gold from these other countries, and is that increasing today versus 2 months ago? Can we see a trend to buying more and more gold from these other countries because, for whatever reason, but some of it may be over reliance on the on the U.S., but for their reasons, is that going to continue? Do you have a sense?
I doubt it.
Okay.
The reason being that I think in the last year plus, some of the world got unusually negative and pessimistic about the future and the outcomes from everything that we see on the table today. That in my opinion, cannot be justified based on the pricing we see today. So, like I said, this is only the third time in history that gold has spiked. Gold cannot stay where it is. That's my opinion. At some point in time, you will see correction, even in those prices, because the world moved away from the gold standard a long time ago, right? Central banks, reserves, right? They all basically realized very quickly that the world has become so large today that no amount of gold that's available can actually be used to back it up, right? So at one time when the gold was the reserve currency, right? It's not true anymore. So right now it's just being powered by these kind of, sort of unusual behaviors we are seeing in the markets. But once they self-correct, my expectation would be that gold will either stay constant, it'll stay stable, or it might actually even correct a little bit in the prices, right? And don't forget that we also have digital gold in the form of cryptos. So we have Bitcoin that has taken a massive hit right now, and you will see people basically sort of do some rotation, right? That they might come out from the hard asset, gold, and maybe buy more crypto because crypto has been beat up.
Yeah. Interesting.
And the younger generation, remember, is much more crypto inclined than gold inclined.
I wondered if some of that had to do with like margin calls. You get yourself extended, you've got to pay it off, so you sell one of your other assets to cover your margin call.
Absolutely.
Yeah, a little bit of that. Okay, so let's get back over to the commodities. If you think about the most valuable companies in the United States and in the world investing into this infrastructure, and they're the most valuable companies, so they have the ability to get a lot of financing. And if those pay off at all, if those cash flow, then they're going to continue to need to buy these raw materials.
Absolutely.
So the end is nowhere in sight for silver or copper or electricians or...
Right. Absolutely. I think that, like I said, this might be unleashing a new wave of economic growth worldwide. Not everybody is going to be a winner. Obviously, there are going to be winners and losers, right? Because even today, for example, Europe is still recessionary. So countries, whether it's the UK or whether it's Italy, Germany, they're all struggling. Their economies are far from being robust the way we see it in the US right now. But then you see other countries, whether it's India, China's coming back a little bit. South Korea is on fire right now. Many of the other emerging markets are doing extremely well. So there'll be new pockets, new frontiers. Just like, for example, how we saw Arizona become a new frontier in our country. There'll be some other countries worldwide that will probably benefit a lot more from this boost that's going on through this new wave of AI. I equate it to what we were seeing in the 1990s, for example. When the internet came in and got commercialized in 95, I don't know if you read the book The World is Flat by Tom Friedman. It basically described how quickly countries like India changed overnight, because now somebody in a remote village in India was able to compete on the same foot with somebody in the US because that business could be done anywhere in the world. Right, the internet changed the game completely for a lot of folks. So what happened in the late 1990s? I think what we're seeing right now is fairly similar. That we are seeing this AI trade going through, and is going to unleash a new way of doing business. There's a lot of optimism about the economic growth that's going to follow. We're seeing some of it already, and I think this is going to be a new world. And of course, there'll be fallouts. Not everybody's going to win. Yes. There'll be a lot of losers. There'll be a lot of money that will be flushed down their toilet. I understand that. There'll be a lot of people who will lose money through investments in the wrong companies. But the winners will completely blow you away.
Okay, so I'm going to segue that into another asset class. Stocks, right? Many, let's call it the S&P 500, the Dow, all the public companies. They are not... I don't think getting as much... I'll throw this as a question. Yeah. The efficiencies and the productivity gains that they are going to see through AI, because AI and different technologies, we're at the very beginning stages of that. What do you see in terms of the stock market as associated with what's happening in the rest of the world and with AI?
It's a great question. So I want to step back a little bit and just give you what I think is very critical why the United States of America is the most successful country in the world when it comes to innovation. We are the only country in the world that truly comes closest to free market capitalism, right? And a lot of people say they think capitalism is a four-letter word, right? Capitalism allows some of even the not so good ideas to be funded because our capital markets truly allow capital to flow in different directions, right? Which doesn't happen, for example, especially in countries where people park their money under the mattress.
Okay.
Because they don't have confidence in their own government, they don't have confidence in the business people, they don't have confidence in the companies, so they don't want to be participating in the capital markets.
Yeah, and maybe regulation stops things from happening as fast.
Yeah. So our country is the best country on the planet when it comes to capital. We are the largest capital market for the world for a good reason, right? So what I'm seeing right now actually is still very positive, even though a couple of things that have worked out is working against investors in some ways. So we have shrunk the public side of the capital market for the stock market. We have fewer companies publicly traded today, right? Compared to where we were 10 years ago, 15 years ago, 20 years ago. And that's probably the reason why the markets are so concentrated today, that 10 companies are almost 40% of the market cap. And these 10 companies include the Magnificent Seven, and they are the powerful drivers of the stock market. If they are doing well, the market does well. If they don't do well, the market is not doing so well, right? They have the best cash flows. They have the best margins. They have the best growth in those cash flows, right? But the private side is expanding too. So look at, for example, 81% of the companies that have more than 100 million in revenue are private. It's only a very small, like less than 1% of all the private companies that you see out there that are publicly traded, right? So the private capital world has evolved very fast and is becoming much more accessible by ordinary investors who basically could never get into these investments because it was a closed club. It was like a country club, which required a membership, and these investors could not basically buy the membership. But that's changing. So today, ordinary investors, accredited investors, if you have more than 1 million in liquid assets, you can actually access capital from Apollo and KKR and Blackstone and BlackRock and all these Ares private companies, private capital funds that are doing a great job providing capital to businesses that don't need to go into the public stock market to find that capital. So it's happening simultaneously. As the public side is shrinking in size, in terms of number of companies, not size, because the dollar volume is still going up, the dollar market cap is still going up, but the number of available companies traded is shrinking. We have roughly 3,700 companies today publicly traded, and that number used to be 10,000 plus 10 years ago, right? So I would say that is very positive for us in the markets because it's allowing more innovation to happen. There's more funding available to fund ideas that normally would go unfunded. And we are becoming much more powerful and stronger, I would say, from an innovation standpoint, especially when we look at the AI trade. And, last year, for example, some people took the message in the wrong direction. There was a DeepSeek moment.
Right.
Where China thought they could basically do everything for like $5 million, which our companies are spending $500 billion on. And you have to think about that a little bit and say, our CEOs like Jensen Huang and Satya Nadella and Sundar Pichai, these guys are very sharp people. They're not stupid.
These are the CEOs. $500 billion. Yeah. For anybody who's listening, the DeepSeek moment is a company in China that got built to do AI. It was a large language model, but it got built very inexpensively, and that had people nervous. Yeah. But you're referencing NVIDIA and some of these and Microsoft.
Yeah. To do something transformational that's going to change the world. It's hard to believe you can do that with $5 million, right? So you have to take the DeepSeek moment with a pinch of salt and say, no, our companies are powerful. They understand innovation. There's tremendous innovation going on where we are the leader in the world. Of course, the rest of the world is going to follow, but we are the leader primarily because our markets are much better regulated, they're more transparent, and they instill much more confidence in the world to want to invest in us. So that's why our capital markets are doing extremely well.
And on that front, because this is really interesting to me, it affects the stock market, but also sort of affects how strong we are as a country long term. If we are building in the U.S. the platforms that the rest of the world, maybe outside of China, but much of the rest of the world is running their business on our platforms. Yeah. They basically become our customers in those scenarios, and that's good for our economic security.
Absolutely. Yeah. Exactly. And that's, again, the reason why the U.S. has stayed on top. Mm-hmm. That every decade or two, we innovate all the new industries. Once they get commoditized, we outsource them. We understand that because it becomes a relatively less, of an advantage for us to keep those here. But any new stuff that happens in the world primarily happens here.
Mm-hmm. Okay, so that's stocks. So you're bullish on U.S. stock market long term?
Long term and also this year. 2026, okay. The estimates for growth in the earnings is somewhere between 12 and 15% on average. But for the really good companies with good cash flows, that includes the NVIDIA type companies, the expectation of the growth is over 20%. So, and margins are getting better. Productivity is going up. So that means the sales per employee, for example, that a lot of people look at has been rising. So these companies are doing more with less. The cost structures are getting better. And so the S&P 500, for example, clearly is on a great platform right now for growth for 2026 and beyond. So I expect the market not to basically do a huge double-digit kind of a deal like we saw in the last 3 years, where the returns were upward of 15 or 20% each year, 3 years in a row. But if we can do a high single-digit, we can do a low double-digit, I think we'll be in great shape.
One thing just came to mind. It wasn't really on my list of things I want to talk to you about, but I recall President Trump announcing that he was going to disallow dividends from defense industry stocks. I believe that's in effect, and I'm wondering how you anticipate something like that will affect those stocks specifically. I guess short-term people might bail because they're not getting the dividends, but I would have to think that those companies are only going to get stronger since they're reinvesting into themselves.
Yeah. In the most beautiful country on the planet, and the land of opportunity, and the most capitalistic society that we have here, is sometimes surprising that we throw out stuff that sounds extremely uncapitalistic, right? Just how we bailed out General Motors and AIG in the 2008-2000 collapse.
Take a piece of Intel.
Yeah, exactly. The buying a piece of Intel right now. I would like to think, and I hope to God I'm wrong, that these are just negotiating tools. That President Trump throws out stuff on the defense sector because he wants to see the defense sector grow. He wants to see more money being plowed into the defense sector, right? Because we want to increase our positioning in the world when it comes to defense. So he's putting this artificial constraint on those companies that, hey, don't do any stock buybacks, don't do any dividends, take whatever cash flow you have, and I want to see it reinvested back in the companies to grow those companies and make them stronger. Similarly, he did the same thing with credit cards. Where he said, we should cap the rates at 10% on the credit cards. I'm saying that's so uncapitalistic.
Please don't do that.
Yeah, exactly. I mean, please. So I don't know where this is going to go, but I hope to God, like I said, these are all just huge sound bites that are simply threats to negotiate things his way at the table. And then eventually we'll come back to whatever is right.
Yeah, I think he wants to win the midterm, so we'll see. I have a lightning round of questions at the end, so that we'll make some predictions on. Okay, next asset class I wanted to ask you about real quick is real estate. Obviously, it's there's different segments of real estate. So maybe we can go through real quick. What do you envision for 2026, 2027 in terms of real estate from a residential, and then maybe the different areas within commercial?
Yeah. So let me just, since we were talking about President Trump throwing out stuff that sounds very uncapitalistic, he did the same thing in the real estate sector too. He said, we will ban large institutional investors from buying homes in an effort to basically provide more affordability.
Yeah. Well, what's your take on that?
I have the data. Less than 1% and maybe at the most 2% of all homes out there are owned by large institutional investors, the way he framed it. So that is not going to make a dent in the pricing of the housing data by simply putting out this huge soundbite that we will not allow Blackstone, for example, to invest in all these homes.
And I haven't. So when in 2010, 9, 10, 11, let's call it 11, 12, I was flipping houses, and I was always competing against one of these big boys. Right. And they would come in with cash, and luckily I was coming in with cash as well, because you kind of need to when you're dealing with the foreclosures and stuff. But the people that were just trying to go get a mortgage they couldn't compete with the cash buyers.
Absolutely. Yeah. So,
but I don't think it's as bad on that anymore.
It's not as bad as it sounds. I'm actually more optimistic on the housing market going forward because we have seen a little bit of relief on the mortgage rates. Not a lot, but a little bit. And we have also seen relief in terms of more people being able to access traditionally, more expensive, but now they're less expensive, like ARM type, loans and all that stuff, right? The housing market is structurally broken. We clearly have the need for many more houses to be built in the US based on where we are today with the demand side. So the construction industry obviously gets, restrained because of all the regulatory issues, all the permit, and processing issues and all those environmental issues. There are a lot of issues that they have to go through to basically put a house on the market, right? And that somebody can afford. My hope is that we will probably see more construction come online, and these are going to be more innovative in the sense that there'll be smaller homes, homes to rent in some cases that will be built instead of just people wanting to buy them. So we should see more homes on the market, I think, going forward, right? We do have a challenge even on that direction that might actually provide some relief. The younger generation is not as keen to buy a house, either because they can't afford one because they've been priced out, or just psychologically, the new Gen Z and the younger folks are just not in any hurry to settle down, have family formation, buy cars. They're still happy using public transportation. They're still happy renting, a place. So I expect the housing market to get better in the next year or two. There'll be more houses, like I said, they'll come online, and you'll see some relief on the affordability part. But the housing market is still in flux. It's still adjusting to the extremely high rates because we went from, like I said, 25 years of almost free money, where the mortgage rates were like 2%, 2.5% on a 30-year fix, and now suddenly we went to 7% plus, right? So it's going to take some time. I think there's going to be some, and there'll be some new frontiers. We have already seen, for example, the immigration / in-migration trends away from the more expensive states to the more inland states which are much more reasonable in terms of affordability, in terms of cost of living. And so we'll probably see more of that. More people will probably leave expensive states like New York and California.
So that'll have an equalizing effect. Yeah, exactly. My sense is the replacement costs probably will not go down because we talked about commodities going up in price. And if we have a little bit less labor to build the houses, at least for the short, medium term, before technology kicks in, I think it's going to get a little bit more expensive before technology drives down the price.
Yes. So on the raw materials part, you're absolutely right. Whether you're looking at lumber, you're looking at whatever you're looking at for the inputs, the prices are going to go up, and that's going to put pressure on the affordability part. But all my friends who are in the home building business tell me that they're seeing tremendous innovation come in the way homes are being built today. And so they are more energy efficient, they're more cost efficient in some ways, they're using new kinds of materials, they're finding new ways to basically build homes that are better, stronger, with maybe the same kind of money or lesser money. So there is that innovation going on in the housing industry, which maybe for the longest time wasn't happening as fast. We were still using 2x4s and we were still doing the things traditionally, but now the way the roofs are being built and other things are happening, there is innovation going on.
You bet. And you look at what like Caterpillar and John Deere are doing at the larger scale, larger companies. They're running like robotic, right? So in many cases, there's a big movement to making things a lot more efficient in terms of moving dirt around, things like that.
Yeah, I'm more worried about the loss of jobs for the younger generation as we go through the next cycle of innovation. We're already seeing pressures come in right now. So the 4.4% unemployment rate is very deceptive. If you peel the onion, you're going to find that the youth between ages 20 and 25 are extremely challenged in finding jobs that would be considered meaningful. We have graduates coming out from leading universities today that cannot find jobs. We have MBAs coming out from Harvard. It was just in the Wall Street Journal last week. And they are going without jobs. I mean, that was unheard of, that you get an MBA from Harvard and you can't find a job, right? But right now, people are going months before they can find something.
It's interesting because we have this simultaneously. We deal with the workforce a little bit through Allegiant Vets. Yeah. We help veterans, and there's a pretty significant shortage of people to work in the trades: welders, project managers, electricians, plumbers. And I don't know that these college graduates grew up thinking they wanted to do that kind of work, but there's a lot of that work out there.
And that's
they get paid a lot of money.
Reverse trade we are seeing now, that you'll see white-collar jobs disappear, blue-collar jobs will grow, and I think that whitening of America that was happening before is going to be lesser. So the whitening of America was really accelerated, in my opinion, by higher education, where they dangle this promise in front of people that everybody deserves the American dream. And instead of saying the American dream includes both white-collar and blue-collar jobs, the universities were promoting white-collar jobs primarily. And said, give us your tuition. Come to college. You deserve a better future. You should not be working and getting your hands dirty in a blue-collar job. You should be behind a desk, right?
I didn't know what you were talking about. You said whitening of America. I hadn't heard that term before, but the white collar. I was thinking of race. For some reason, I was like, what?
No.
The white collar.
This has been going on for a long time.
Yes.
That universities... which in my opinion, has been done unfairly. So if when you talk about inflation, healthcare and education are the most inflationary. Many of the other stuff that you consume in life actually have stayed constant or maybe not as bad. But healthcare and education have gone through the roof. Yeah. The pricing is extremely absurd.
Anything the government gets involved in seems to get more and more expensive.
Yeah. So universities are terrible, in my opinion, in basically taking advantage of the emotional need to invest in yourself. So they say, come to college, we'll take your tuition. We might be very inefficient ourselves as to how we run the business. Many of us have deficits of our own, but we'll show you this promise. And by the way, when you graduate, you're going to get this beautiful job.
Yeah. And you're going to have a lot of debt because the government's going to offer you, loans. Yeah. So we can jacks up the price of the tuition because, there's more money out there chasing these spots. Yeah. Amazing.
When was the last time you saw university presidents getting pulled into Congress for a hearing? That, hey, by the way, what's happening? Why are students not finding jobs coming out from these wonderful programs you guys have on campus, right?
It's probably coming soon. Huh? Okay, so we talked about real estate a little bit. Bonds, we've touched on that a little bit. You kind of expect bonds to not get worse.
No, I think the bond market is getting normalized too.
Okay.
So remember, in 2022, when the stock market crashed, the bond market crashed too, which is not usual because the bond market usually works slightly differently from the stock market. But I think now with the rates getting normalized and the economy getting normalized, the bond market, the yield curve is getting normalized. I think we talked about this before, but I'm going to bring it up again. The yield curve, which is the term structure, right, of the interest rates, traditionally, historically, longer term bonds should have higher rates than the shorter term bonds. If the yield curve inverts by more than 25 basis points and stays inverted for more than a month, that has been a fairly powerful predictor of a recession to come. Our yield curve stayed inverted for a couple of years plus post-COVID, when all this free money was put on the table and inflation shot up to the roof. Pretty much the short end went up really high. The long end stayed where it was. We are finally uninverting the yield curve. Thank God there was no recession. So that signal failed. The yield curve inversion that used to be a great predictor, that didn't work. My thinking is that the longer end will probably go up a little bit more, because there will be pressure from that fiscal policy you're talking about, that we will continue to finance our deficits using longer term bonds, right? The shorter end is already coming down, so the yield curve is going to steepen. But what it's going to do is it's going to make the bond market attractive again for investors, which was not true, because in the last 3 years, investors were losing money on a total return basis. So the yields were looking okay, but because as the rates were going up, the bond values were crashing, so you lost more money in the principal that could not be offset with the interest rate that you were bringing in, right? So I'm actually very encouraged. The 2025 was actually a very decent year in the bond market if you're a bond investor, and 26 will be, I think, a better year. And going forward, like I said, if it gets normalized, that's going to be great for fixed income investors. Remember, there's a lot of people who are older, who don't have the risk tolerance to be in the stock market, and they are dependent on income coming in from the portfolios. They're paying the bills, including for food on the table. So we want the bond market to normalize so that the savers and the investors in the bond market are not basically hurting and going the other way.
Okay, so I could go on all day, but I know we're running out of time, and I promised myself I wanted to get some predictions so that when I talk to you again in the future, we could go back and compare how you did and how I did, because I'm going to make a prediction too, and obviously I'm a novice.
Last year we did pretty good.
You're right
back
on.
And check us what I said last year.
Yeah, you were good. I don't think I predicted. So don't listen to me. In fact, this is not investment advice. So just so you know, none of this is investment advice, and it's all opinion. So just kind of do a lightning predictions round. Where's the S&P right now?
It's at 6,900.
6,900. Okay, so December 31 next year, where will the S&P be?
Above 7,500.
Okay,
is my call.
I was going to say 7,500 too. Okay, I'll say 7,600.
Okay.
Fourth quarter GDP this year.
You want the aggregate for the whole year, or just
no,
the
just
Q4?
So because I can see us.
Q4
I predict
from last year, you mean?
A Q4 from 2025 is we kind of talked about being in the 5% range.
Yeah.
I'm going to say it's going to be at 7%.
Wow.
Yeah.
You're way above where I was going to be. I would have said 3.5, 4.
You think it's going to be below this year's?
Because we already have momentum from last year,
right?
Going into this year.
I'm going to say we're going to accelerate.
On top of that,
I'm going to say we're going to accelerate because of all this AI spend. Okay. Again, I'm a novice, so don't listen to me. Gold price right now, I think right around the gold price right now is around 5,000. Right in there.
5,000.
Is a little above 5,000? Yeah. Okay. So where will gold be on 12/31 next year?
I would say it will stabilize around 6,000.
Okay, that's what I was going to say too. So I'll go 5,900.
Okay.
Okay. Our national debt is 38 trillion and some change. Where will our national debt be?
42 trillion.
Okay, I'll say 41. Okay. Q4 CPI. Yeah. Right now, you're saying it's in the 2.5, 2.7.
Yeah.
Where will it be in Q4 next year?
I would say 2.5.
Okay. I'm going to say 2.2. Okay. So 10-year note is 10-year is 4.2. Yeah. Where will it be? You said it's going to go up a couple.
4.5.
4.5. Okay, I'll say. I think I projected this on a different show. I think I said 4.2, so I'm going to stay with it. Okay, so will the GOP keep the House in the midterms?
Barely.
Okay, I was going to say the same thing. Fed chair, will Warsh get? Will he get accepted?
I would give him a 90% chance.
Okay, I'm going to say
and if he does, it'll be good for us.
Yeah. Okay.
There's a 10% chance they'll derail him.
Yeah, derail him. But I think ultimately, that might create uncertainty, and hopefully we don't close down the government, and that could destroy.
That's another reason I'm very confident we're going to get a rate cut. Because it's a new chair coming in, and whoever gets in, doesn't matter, will be under pressure from President Trump. Yeah.
Okay, so the T-bill rate right now is what is it?
About 2.8.
2.8.
Yeah.
So where will it be 12/31?
I would say it will stay where it is.
Okay. I'm going to say it'll be 2.5.
Okay.
And who's going to win the Super Bowl?
For next year?
Yeah. Because we recorded this the day after Seattle just spanked the Patriots.
I was going to pick the Broncos.
Oh, nice. Okay, I'm going to take the Niners just because there's my team. Okay, two more. Unemployment rate is at 4.5 right now.
Yeah.
Where will it be this time? The 12/31?
5.
Oh, going up, huh?
Yeah.
Okay.
I expect the labor market to become worse.
Okay. I'm going to say 4.7 then. Okay. And Bitcoin's in 60s now?
Yeah. It's 68,000 this morning.
Okay, 68,000. Where do you predict it'll be 12/31?
I would say probably closer to about 100,000.
Okay, I'm going to say 50,000.
Okay. Right. You're pessimistic on Bitcoin.
I just see the trend, so we'll see.
It's a 4-year crash, right? They talk about the 4-year half-life. Yeah.
So we'll see. Sanjay, you are a wealth of knowledge and wisdom. We are so lucky to have you on our show and in Sacramento. So thanks for coming on and making it fun and really giving us all something to think about.
Well, thank you for having me on the show. And not everything I say is going to come out accurate, but hey, if I can have a hit rate which is more accurate than not being accurate, I think we're in good shape.
I love it. All right. Thanks again. I appreciate you.
Thank you again, Mark.
You bet.
Thanks for watching today's show. My goal for every episode is that you find a takeaway, something tangible you can use in your business today. And if you have a comment about a favorite takeaway, feel free to put it in the box below. And if you have a topic that you'd like me to bring up on the show, don't forget to let me know. And also, don't forget to subscribe to our YouTube channel if you want to learn more about entrepreneurship. Because at Haney Biz, we are always by your side.